What if I told you that one of the most iconic brands in the world just posted earnings that surprised Wall Street, but not in the way you'd expect? Nike stock just soared nearly 18% in a single day, and yet, this quarter was one of its ugliest in recent memory. So why is the market reacting with optimism? Is this the bottom for Nike, or just a temporary bounce in a long-term decline? Today on Dividend Dreamer, we're diving deep into this dramatic twist in Nike's story, breaking down the numbers, the warning signs, and whether this is a smart entry point or a trap. Nike's earnings are in, and despite a slew of negative headlines, the market responded with a surprising 17% jump. On the surface, this looks like a major win, but once you peel back the layers, the reality is a bit more complicated. Let's start with the facts. Nike beat expectations this quarter, but make no mistake, this was still a very rough 3 months. Revenues in key markets like North America, Europe, and China were all down year over year. Gross profit, margins, and EPS all took a hit. The only reason Wall Street reacted positively was because things weren't as bad as feared. Management had already warned investors to expect a tough quarter, and that pre-warning likely softened the blow. This was a classic case of better than feared earnings, not actual strength. Now, despite the recent pop, Nike stock is still down a staggering 63% from its 2021 peak. Over a 6-year span, it's fallen 43%. So while the recent rally has brought it back to flat on the year, investors are still deep in the red. The current market cap is inching back toward $100 billion, but fundamentals remain shaky. Let's talk valuation. With margins and earnings declining, Nike doesn't exactly scream bargain. The trailing PE is around 29 and forward PE sits near 37. That's high, especially when you consider the company hasn't shown revenue growth in 3 years and is projected to see declines in both revenue and EPS going forward. In short, the financials don't yet justify the valuation. So what's the bull case? This is where the turnaround story keyword comes in. Nike is in transition, and management admits the path to recovery will be longer than expected. For long-term investors, this isn't about short-term results. It's about patience and belief in a future rebound. Yes, Nike still pays a dividend and continues to buy back shares, but many feel they missed a golden opportunity to buy back more aggressively when the stock dipped below $60. Looking ahead, Nike's forecasts are still gloomy. Fiscal 2026 revenue is expected to fall by 11.2%, with modest growth not projected until fiscal 2027 and 2028. In the near term, Q1 revenue is forecast to decline in the mid-single digits, and margins are expected to take another hit, particularly due to new tariffs. Speaking of tariffs, Nike is already shifting production away from China to reduce its exposure. They're aiming to cut China-sourced U.S. imports from 16% to high single digits by the end of fiscal 2026. They're also introducing phased price increases in the U.S. starting in fall 2025, aiming to offset the estimated $1 billion cost from these tariffs. The company believes its mitigation plan will limit the overall gross margin impact to about 75 basis points in 2026. Still, it's not just external pressures dragging Nike down. Internal missteps have played a role too. The company over-indexed on digital sales during the pandemic and neglected its retail relationships, leading to bloated inventories and declining customer engagement. This is where Nike's leadership has a lot to prove. Competition is another major piece of this puzzle. Nike is no longer the only name in the game. Brands like On Holding are growing at over 20% annually, and even smaller segments like their apparel line are expanding rapidly. Deckers, with its HOKA and UGG brands, has also seen consistent double-digit growth. And then there's Adidas, a direct rival and global giant, that's now projected to grow faster than Nike over the next few years. In other words, this isn't just a Nike problem, it's a market shift. Competitors are gaining ground, and Nike must respond. To fix this, Nike is leaning on a new strategy, the sport offense. This initiative focuses on core sports categories, revamping their product line, connecting better with consumers, and re-energizing their marketplace presence. The goal? Get the growth engine running again. But here's the big question for investors. Is now the right time to jump in? Nike's own management says the effects of these turnaround efforts won't be visible until the holiday season at the earliest. So you could wait, or if you believe in the long-term rebound, explore options, literally. Some investors, like Bill Ackman, have moved to long-dated call options instead of stock, giving themselves time without tying up as much capital. At the end of the day, Nike still has powerful brand equity, a massive marketing budget, and deep global reach. But it also has major structural and competitive challenges to overcome. Whether it reclaims its former glory or continues to lag depends entirely on how well it executes this turnaround. That's it for today's Nike stock analysis here on Dividend Dreamer. If you found this breakdown helpful and want more updates on turnaround stories, earnings reports, and market movers, make sure to hit that like button and subscribe to the channel. It really helps, and you can always unsubscribe later if you change your mind. Thanks for watching, and we'll see you in the next one.